In this video, traders, we're going to look at the rectangle continuation pattern. Stay tuned. Hey traders, a very warm welcome to you. Okay, so the rectangle continuation pattern, sometimes known as a trading range, sometimes known as consolidation, all sorts of different names and phrases for it. But let's look into what it is, how it's formed, what we can look out for, most importantly, how we can trade it to make some profitable trades. All right, so this is really what it's like. This is what we're looking for. We have a good trend. In this case, this is a rectangle after a downtrend. So this is on a swing trading chart. By the way, you can use this on any market. It's purely based on supply demand, which if you watch any of my videos, you know that I like this kind of stuff. And welcome back, subscribers. If you are a seasoned viewer of the channel, if you're brand new, consider subscribing below. So this is a swing chart. This could be any market, FX indices, commodities, whatever. Trend down, and we get this multi-day or multi-week consolidation where price is accepted at a new level. So if you can imagine, all we saw was this. Forget this breakdown after here. We just saw this. This had come down from way the way up here. We've got this on the screen just about. Let's assume that's come down from way the way up there. We've pushed down, we're at new fresh territory lows, and we're consolidating for day 1, 2, 3 in this example, or month 1, 2, 3. It doesn't matter, but it's more of a swing trading thing than an intraday perspective. Although it can be used, we'll go back into that in a second. Pushes down, we consolidate. In other words, price is accepting, or the buyers and sellers are accepting this as a new level, and it's at lows, and they're accepting it, okay? But we don't have bulls who are strong enough yet, or buyers who are aggressive enough yet, to push this thing to new highs or push it back up. So we get this consolidation, almost like a bear flag, but slightly different in that this could possibly have come lower here. There's a few different anomalies. You're just literally isolating this rectangle. It's pretty similar to the triangle, but we've got parallel lines. So the trend prior, check. We must see that. That's an important part of this. We don't have that. It's just a range in the middle of nowhere, and the chances of you guessing the way it's going to go or getting on a good strong move are far less, in my opinion, than when you've got a trend prior. And that's similar for a lot of chart patterns, actually. Okay, number 2, 4 key points. What does that mean? It means that you've got to have at least one touch here, 2 touches here, 1 touch here, 2 touches here. So 2 tags of a parallel resistance and support line. Support being below, resistance being above. So you want that 1, 2, 3, 4. So at least 2 above, at least 2 below. More than likely it's going to be more, and obviously the longer it is, the more touches you're going to get, but you need at least that. You can't just have one. One doesn't count. One's just a pullback. All right, so you need that second kind of double top, double bottom, double top, triple bottom within that range. Okay. Volume. Now, volume's a funny one because often you'll find that there's no real pattern to this. Sometimes volume might dry up in the rectangle. Sometimes you'll get no volume at all as people kind of just deciding what's going on. Sometimes I've seen instances in this where volume actually really starts to get aggressive. It spikes up as it kind of blasts up from the low, and people think that's the low, and they think, oh yeah, we're going to rip to the upside, and they buy it, and then it stalls again, and you get a big burst in volume, then it calms down again. So sometimes it's very difficult to quantify that volume or qualify that volume. So be flexible with that. Don't use that too much as a filter for the trade, but just keep an eye and see where the volume's coming in. There's more volume coming at the lows, more volume coming at the highs, just kind of gauging it, but okay, not being too overly weighted onto what the volume's doing. All right, number 4, duration. The longer the rectangle period, generally speaking, the more aggressive the break is going to be. Now that's the textbook way of looking at it, and I do agree. Long times periods means that when it breaks, a lot of people are involved in it coming out of a door, and that's fine. That makes perfect sense because people have accepted it for so long that when it comes into a fresh low, it's like, hey, that's been that price. It's been between 20 and 30 bucks a share, whatever it was, all that time. All of a sudden, it's now broken that. Hey, everyone's looking at it. Everyone's got their attention to it. That's a tradable opportunity. But there's a little caveat to that, which I want to add in this video, is that if it happens very, very quickly, it can also indicate that, hey, there's an urgency there, especially if it's continuation, which is generally the best way of trading this. Continuation, it might mean there's a bit of urgency there. And often you might get a catalyst that causes it to push out. But that's maybe we're going a bit too far, and let's not overcomplicate things. So duration, longer, the better generally. Let's keep it broad. Number 5, breakout confirmation. So we probably want to see a breakout in the direction of the rectangle. That generally is better because you've got the trend behind it, you've got the consolidation, and you've got the further break. Now, confirmation, you may want to see kind of an X% move from here to here. You may want to see, say, 3-day closes below to confirm. You can judge it and see for yourself. But bearing in mind, number 6 here, and this probably should be together really, you often will get a pullback to the break. So if you see that confirmation, if you're very, very shy and cautious about this, if you're very aggressive, you're going to be smacking it short every time it breaks through there. But you're going to be prepared for a few fake outs because these may well just probe through and fake you out. Fine, you accept that. It's kind of one of the things that you get for being early. You kind of get a few false breakouts. If you wait for that confirmation, so 1, 2, 3 closes below, if you're going to chase it there, you've got to be prepared for it to pull all the way back and then roll over again. So if you're extra cautious, you can wait for the three closes below, for example. There's your confirmation. Then wait again for it to pull back to the support it broke through and then take the short there. So you've seen the evidence of sellers coming in. You've seen consistent selling 3 days, pull back at some point. Hey, you might not get it back to that that perfect sweet spot. Markets are never textbook, but you might get a little bit of a pullback there and you can get on board. And whether you guide it from there, whether you say, hey, as long as it's between there and here, I'm still going to get short on a pullback, you can trade it that way. All right, and targets, many people like to extrapolate the distance between. So let's say that was $10 if we're talking about a stock, or 100 pips if we're talking about a currency pair. Many people would like to say, okay, I've got my purple pen. Let's keep it the same color, purple. Many people say, okay, well, I'll take $10 and I'll put it down here. Now, obviously, that's going to be different if we're talking a lower dollar amount because the percentage is going to be affected. So you might use it as a percentage and say, okay, well, it's $10, that's a 10% range. What's 10% below that? That's going to be that. And of course, you need to adjust it based on that. If you're a currency pair, not so much. If it's an index, not so much. If that's 500 points, maybe that's going to be 500 points. The point is, this distance between here and here very often equals this distance. So it's a good place to put your final targets if you're trading a break of this rectangle move. Anyway, guys, that's the rectangle continuation pattern. If you like the video, give it a thumbs up. See you next one. Take care. Bye-bye.